So the Federal Open Markets Committee wrapped up their meeting this week, and Fed Chairman Powell delivered the news that they were going to keep rates steady and cited that stagflation was the primary driver. So what is stagflation and what does it mean for the markets? So let's dive in. My name is Brian Cannon and welcome to Markets in 5. Right, I'm going to go through a couple of charts today. First is the normal kind of S&P, just to see where we are and how we've kind of transpired over the last couple of weeks since the last video. But the market is having some constructive rebound, right? So we went kind of lower lows, lower highs, and forming a downside resistance kind of barrier that was tough to get through. Well, we've broken that barrier, and we have, started to begin a series of higher highs and higher lows here. So again, it's still a little bit early, but it's starting to see some constructive patterns starting to emerge. All right, and if we zoom into that same chart, a couple of things become a little bit more apparent. The last time that the RSI tried to get above the 50 level, it was met, the market was met with the resistance of the 200-day moving average. Couldn't get above it, RSI dropped back down, market falls down. This time, which is a little bit different, RSI has now broken through positively through the 50 and seems to be constructively heading up. And in doing that, you're starting to see some of the moving day averages starting to lip up or curl up, which is very, very constructive. So there's some positive signs happening. And then obviously this downside trend is, seems to be kind of working through. I mean, really, we need to get above that 200-day moving average and that most recent high to feel very confident that we are trending up. So we could certainly reject off the 200. We could certainly reject off of this Fibonacci level. This is Fibonacci retracement level that rejected here. So we've got a little bit of work to do. So I guess what I'm saying is that there's been some constructive things that have happened since kind of bottoming, but we still have a little bit more work to do before we can kind of breathe that final sigh of relief. I mean, I don't know if you ever breathe a sigh of relief in the market, especially if you watch the news. But there is some constructive things happening, but we do have a little bit more work to do to feel fully confident that we're on the right track. But we do have MACD is heading up as well. So all in all, we've got some pretty serious resistance coming up. If we can get through that, it's going to be green light. If we reject off of that, then we're looking for where are we going to fall down a little bit. So we're watching those levels closely. All right, now to stagflation. What is it and what does it mean? Stagflation is simply slowing growth combined with inflation. So if you have high costs and you have things that are slowing, then it can create a pretty not good situation for the market. Let's put it that way. So in fact, if we look historically, the only period of serious stagflation we had over the last 100 years happened in the 70s, and that was just basically a go nowhere market for the better part of 13 years. So there were a lot of downs and ups and downs and ups, but not a lot, no real headway as far as breaking out. So now when you overlay, when you take a look at what is inflation historically relative to these secular periods, so the word secular just means long term, and bear market means no new high. So, I do believe that the market cycles over time, and history does tend to repeat. And so when we look at this chart, you can see that, you could probably just look real briefly, not know much about the market and say, hey, we might be a little bit closer to the end than the beginning. So, the thing is, it could last another 4 or 5 years. I don't think it's going to come anywhere near lasting another 10 years. I don't think we're going to be 22 years into this bull market, but anything can happen. I mean, who the heck knows, right? That's why we play the trends, why we use quantitative analysis to help us make those decisions on a kind of a short term, a medium term, and a long term kind of perspective. But essentially, I think that we're going to be, I think it's tough to believe that we're going to evade this nasty bout of inflation that we've got. Especially when you consider that the big periods of inflation historically have all been in the midst of a secular bear market. In fact, we haven't had a secular bear market without inflation. So, I'm a little skeptical of the long-term view. The thing is, I don't know if it's going to be 6 months, 6 days, 6 years. At some point, we're going to find ourselves in the next secular bear market. And that's where risk management is going to be extremely important, and making sure that that you follow the trend. And if the trend is down, you want to take monies off, and if you follow the trend up, you want to put monies to work. So we're at that period where it's unknown, right? It's either going to fall down further, or it's going to go up a little bit more. So we're just being a little bit more active in this period of time until we figure out which direction the market ultimately wants to go in. All right, and this last chart kind of looks like spaghetti soup, I know, but this is the 10-year this is the Treasury yield curve. So the black line represents the relationship between the 10-year and the 2-year Treasury. And it's put in the backdrop or compared against the S&P 500 in the pink and unemployment in the orange. And so this chart, I really like this chart because it tells you a lot about what happens in essentially the relationship between things. So when the yield curve inverts, it means that rates are high. It means that it means that the Fed is fighting either inflation, or they're fighting a runaway market. They're trying to slow things down. Well, how do you slow things down? You want to strip liquidity from the market. You want to increase the cost of products so that people stop spending and stop buying. So it just kind of slows the market down. And so when you do that, obviously, then you have to, it's kind of like, threading the needle. You better get it just right, or you're going to potentially take a runaway market and send it in the wrong direction quick. So, and historically speaking, that the Fed's got a history of doing that. So when you have an inverted yield curve, and then the market starts to roll over, well, then they normalize the yield curve and then steepen it, right? So they're really, really, really starting to drop rates fast so that they can save this market from rolling over. And then you see unemployment as a lagging indicator start to shoot up. And generally speaking, when you have an inverted yield curve, it's always followed by a recession. So is it 6 months till that recession? Is it 2 years to that recession? Nobody knows. But if you take that, fast forward to today, we've had this nasty inverted yield curve. The yield curve is just normalized in 2025, and it's beginning to steepen as this market has rolled over a little bit. So the question is the market going to continue rolling over? Is the yield curve going to get very steep and really try to save the market from rolling over? To be determined. But one factor we need to really watch, which is incredibly important, I think it's the key metric that's going to kind of tell the story eventually, is unemployment. So unemployment did come off of its bottoms, but historically speaking, we're still very, very low unemployment. So, and right now it seems to be kind of going sideways. So if we get a real lift off in unemployment, you can pretty much rest assured that they're going to steepen these rates, and it's because this market's rolling over. So there's a lot to be watching in the next several years. But when you combine all of that into kind of just a theory, I would say that we've got, I don't think we have 10 years to a recession. I think it's sooner than that. But again, that's why we use technical analysis and quantitative trading in order to help determine the amount of risk that we should or shouldn't be accepting in the market. So in wrapping up, ultimately stagflation historically we haven't had too many times throughout history. But when it did hit, it was a doozy. So, it just drives home the importance of risk management in your trading and having a process. So, but if you have any questions, give me a shout, and I'll see you on the next Markets in 5.